Are you worried you're paying too much in taxes? Are you concerned these taxes are cutting into your savings and may hurt your chances for a successful retirement? Effective year-end tax planning can help you keep more of what you've earned. However, many people don't think about their income taxes until it's time to file them in April. Unfortunately, by then, few options are available to reduce your prior year income tax liability. I'll let you in on a little secret. If you want to effectively and methodically reduce your income taxes, you must act before year ends. This is especially true for people near or in retirement, as several of these strategies involve retirement and investment accounts. In this video, we'll look at 7 strategies you should consider implementing before year end to reduce your income taxes and help you save more of what you have earned. But first, allow me to introduce myself. My name is JP Geisbauer, founder of Centerpoint Financial Management. I'm a certified financial planner professional, a certified public accountant, and this channel is dedicated to helping diligent savers maximize their lives and minimize taxes as they transition into retirement. I release new videos weekly, so if you enjoy this content, please hit like or subscribe, and you'll be notified when these videos are released. Year-end tax planning is often overshadowed by the hustle and bustle of the holiday season. However, this time of year presents a golden opportunity to reassess your current year income and maximize savings. By implementing effective tax strategies, you can reduce tax liabilities and increase your funds available for retirement. There's a significant advantage to being informed about year-end tax strategies. You can make timely adjustments to your financial plan with correct information. This could mean the difference between struggling with unforeseen tax burdens or enjoying a comfortable retirement. After all, when saving for retirement, every dollar counts, and minimizing tax liabilities is a crucial part of the equation. Understanding these concepts is essential, but executing on them is where the real benefits lie. The earlier in the year you start tax planning, the more you can potentially save. And doing this consistently over years, if not decades, can dramatically strengthen your retirement plan. So make sure you watch until the very end to see how these strategies may be able to help you. But please understand, this is not specific income tax or financial planning advice. This information is for educational and entertainment purposes only. If you feel that any of these strategies could be helpful to you, make sure you consult with your own tax professional or financial advisor. So without further ado, here are the strategies. Number 1, assess your current income tax situation. Those near or in retirement can often have multiple sources of income. Understanding how each is taxed is vital for effective planning. Usual income streams can stem from wages, pensions, investments, rental properties, and Social Security. Each income type may be subject to different tax rules, and knowing how these rules interact can help you make smarter, more tax-efficient financial decisions. Wages and salaries are straightforward. However, ensuring that you are withholding the correct amount for taxes is essential. This can prevent unexpected tax bills when filing your tax returns. With investments, it's important to recognize the distinction between short-term and long-term capital gains, as they are taxed differently. Interest income taxation depends on whether it's municipal, corporate, or other government debt. Depreciation, repairs, maintenance, and other expenses can help offset rental income. Additionally, for those receiving Social Security or enrolled in Medicare benefits, understanding the tax implications and IRMA surcharges based on income can also help prevent surprises. Actively managing your income can help you optimize your tax situation. This involves evaluating potential changes such as raises, bonuses, outsized investment performance, and how they affect your overall tax liability. Once you calculate your current level and type of income, strategic moves can be made to manage your tax liability and develop your long-term financial plan more effectively. Number 2, maximize retirement plan contributions. If you are still working, maximizing your retirement plan contributions can dramatically reduce your income tax. If it makes sense with your long-term financial plan, make sure you contribute the maximum allowable amount to your retirement plan, including any available catch-up contributions. This strategy helps you save for retirement and provides valuable tax benefits in the current year if you elect to make pre-tax contributions. Adjusting retirement plan elections for the remainder of the year may also make sense, depending on your current taxable income and personal financial plan. This could mean switching from pre-tax to a Roth 401k contribution for the remainder of the year. Roth contributions may also make sense in a down market, so the investments can grow more quickly when the market ultimately recovers. Number three, evaluate possible Roth conversions. Roth conversions are a strategic way to manage tax liabilities before and during retirement. By converting traditional IRAs or 401ks to Roth balances, individuals can pay taxes on their contributions in the year of the conversion. This allows you to manage your tax liability in any year. Once the funds are in the Roth account, they can grow tax-free and be withdrawn tax-free during retirement. This move can be particularly beneficial for those expecting a higher tax rate later in life, or those who may have had an abnormally low earnings year in the current year. Deciding to convert pre-tax to Roth should only be done after carefully considering current and future tax implications. Pre-retirees should assess their current tax bracket and determine if a conversion aligns with their long-term financial goals. It's also essential to factor in potential income or tax legislation changes that may affect the decision, but that can be difficult, if not impossible, to predict with any certainty. By strategically executing a Roth conversion, individuals can diversify their retirement income sources and potentially reduce overall tax liability. This approach offers flexibility in managing retirement distributions and ensures a more stable financial future by taking the income tax variable out of the retirement equation. I did a specific video on Roth conversion opportunities and how they may present themselves during our lifetimes. I'll have a link to that in the description below. Number four, strategically managing capital gains and losses. Reviewing capital gains and loss activity is critical for year-end tax planning. Managing these effectively can lead to significant income tax savings. Generally speaking, capital gains occur when an investment is sold for more than its purchase price. Losses arise when an investment sells for less. Understanding how these affect income taxes is essential for making informed financial decisions. While tax loss harvesting or strategic gain realization should be a year-round consideration, giving this planning strategy special attention at the end of the year is always a good idea. The tax rate for capital gains varies based upon how long the asset was held. Short-term gains from assets held for less than a year are taxed at ordinary income tax rates, whereas long-term gains enjoy reduced rates. For pre-retirees, strategically timing asset sales can minimize tax liabilities associated with these gains. One often overlooked consideration is that for long-term capital gains, taxpayers can take advantage of the 0% tax rate for joint filers with income tax below a certain level, or the 15% above a certain level. However, if income is above an even higher level, the long-term capital gains will be subject to a 20% long-term capital gains rate. Knowing and taking advantage of these different long-term capital gains rates presents an excellent opportunity to strategically sell portions of large, highly appreciated, or concentrated positions. Pairing gains with losses can also yield tax benefits. This strategy, known as tax loss harvesting, involves selling underperforming assets to offset tax liabilities from gains. By reducing the overall taxable income, pre-retirees can effectively manage their investment portfolios and potentially improve long-term returns. Strategic gain harvesting can occur in years when retirees have lower taxable income and can sell positions at the 0% long-term capital gains rate. Understanding and using this different tax treatment to your advantage can help minimize your income taxes. Number five, planning required minimum distributions. Managing required minimum distributions, or RMDs, are crucial to tax and retirement income planning. These mandatory withdrawals from retirement accounts ensure that tax-deferred savings are eventually taxed. Failure to take RMDs can result in severe penalties, making it imperative for individuals to understand and plan for these distributions. Planning for RMDs involves more than simply calculating withdrawal amounts. Pre-retirees should consider the timing of distributions to effectively manage their tax liabilities. Spreading withdrawals throughout the year or taking them at strategic intervals can help optimize tax efficiency and maintain financial stability. As mentioned earlier in this video, strategic Roth conversions can help reduce future RMDs and related income taxes. Number six, charitable contributions and deductions. If your itemized deductions approach or exceed the standard deduction threshold, additional charitable giving is an excellent way to reduce your income tax in the current year. One often overlooked strategy for charitable contributions is donating appreciated shares to qualifying charities. By donating the shares, you can avoid recognizing the capital gain that would have been triggered if you sold the shares. Additionally, you recognize the charitable contribution donation in the fair market value of the donated shares. This is much more tax efficient than selling shares, recognizing the gain, then gifting the cash. Just make sure you are mindful of the AGI limitations of appreciated stock compared with straight cash donations. Another creative way to give to charities is via a qualified charitable distribution, or QCD. This strategy is available to individuals over a certain age, around the early 70s. The annual limit is a little over $100,000, and this can be a great way to proactively take tax-free distributions from an IRA before RMDs begin. Any amount taken as a QCD offsets the RMD by the same amount, effectively reducing the current year's taxable income. And yet another way to maximize charitable contributions is through donor-advised funds. Funding a donor-advised fund is like making a prepaid charitable contribution, where you can recognize the deduction in the year you fund the account, but you can transfer the money from the fund to qualified charities in later years. This is an incredible tool that can help people minimize their income taxes. I did a video specifically focused on charitable giving and how it can help reduce income taxes. If you'd like to learn more about these strategies, please find a link in the description below. Number 7, estate planning and annual exclusion gifting. Estate planning is a vital component of year-end tax planning. Properly structured estate plans can minimize taxes and ensure assets are distributed according to an individual's wishes. By addressing estate planning early, those in and near retirement can take advantage of various strategies to reduce potential taxes on their estates. One critical aspect of estate planning is understanding the current estate tax exemption. You should evaluate your current and projected net worth against current and projected limits when considering such strategies as gifting, trusts, and charitable donations to minimize estate tax liabilities. Unfortunately, this area feels like a tax policy ping pong ball, and limits seem to bounce around depending on which political party is in power. But staying abreast of these changes and making the necessary adjustments can help ensure that you stay on the right side of these limits. Additionally, take this time to ensure that estate plans are up to date and reflect any changes in personal circumstances or tax laws. Regularly reviewing beneficiary designations, will provisions, and trust documents can prevent unintended consequences and provide peace of mind. Year-end tax planning is a critical step if you're looking to optimize your financial future. Understanding and implementing key strategies can reduce tax liabilities, enhance retirement savings, and help you achieve greater financial stability now and in retirement. Taking the time to address year-end tax moves provides immediate benefits and fosters a sense of preparedness and confidence. But it's not always easy, and it can be downright tricky. If you need additional guidance, contact a qualified CPA or financial advisor to help you assess your situation. By staying informed and proactive, you can help create financial peace of mind and success during your retirement years. If you are near or in retirement, planning around RMDs or required minimum distributions can be particularly tricky. I did a video on how to reduce future RMDs to save money on taxes. If you are actively saving pre-tax money in your retirement plan to avoid income taxes now, you will want to watch this video to see how you can reduce taxes on RMDs in the future. If you've made it this far, thanks for watching. If you enjoyed this video, please hit like or subscribe. Thanks again for watching, and I will see you next time.